out an application for the healthcare sector analyst for next semester. So if you're interested in applying, please look out for that tonight, and it will be due, I think in a week, and then we'll probably start interviews right after that. So please apply. Other than that, Mari and Elias, you take it over whenever you need.
Perfect. I'll share my screen right now. Okay, please let me know if you can see it.
Yep, you're good.
Excellent. So hope you guys are having a great day. Mari and I will be pitching Cigna. So just a couple of things that we're going to go over. Obviously, our investment thesis, why we think this company is a good buy, the industry overview, essentially what we think is going to happen with the industry, a company analysis. Then we'll move on to our ESG integration, mainly seeing how this company is mainly tackling the main issues that we see ESG-wise, and then we'll finish off with the valuation. As stated previously, the main goal of the healthcare sector is to provide looking to open up positions in companies that have well-established guidelines and are determined to move forward in a greener, more sustainable direction, while also providing financial value to its shareholders. We want to look for companies that provide better and more affordable access to healthcare, have well-established anti-corruption practices, and are constantly innovating in order to better serve patients going into the future. My name is Elias Pajares. I'm currently a junior, majoring in finance and also minoring in CIS and data technologies, and my partner is...
Hi everyone, my name is Mari Thompson. I'm a senior majoring in finance and minoring in computer information systems.
Just going over our investment thesis, we think Cigna's sales growth, acquisition strategy, and strong corporate management, combined with her mitigation of company and industry-wide risk, which we'll go over later, makes the company stand out amongst its competitors as a strong investment currently undervalued by the market. We currently recommend to buy Cigna at its current market price or current closing prices as of yesterday of $206.94, and we're expecting a price target of around $262. They have a market cap of $74 billion, and the main reasoning for our investment thesis is due to the ESG factors of they have a low carbon intensity as compared to the industry. They have strong labor management initiatives. Their risk management policies for social and demographic risk are very clearly outlined, and we think they're the strongest in the industry. Some of the main catalysts that we see for the growth that we're expecting is obviously the Biden administration. The Biden administration will essentially require more and more people to have health insurance. Their strong acquisition strategy, divestiture of non-health units, and their growing membership base. Some of the risks that we do see inherent with the industry as well as with Cigna as a whole is obviously price competition. By that, we mean obviously like drug pricing that they're obviously going to cover, and also price competition within their membership plans. The opioid epidemic is obviously something that has been very rampant, at least in the pharmaceuticals industry, and it's also been impacting the health insurance industry and their dependency on third-party relationships. So for the industry outlooks, we've mainly seen industry trends where the healthcare reforms have actually motivated many health insurance companies to consolidate to reduce costs and maximize profit. Health insurers are expected to experience challenges resulting from medical cost inflation. So essentially the cost of medical treatment, medical devices, and pharmaceuticals actually going up. And the industry will likely be threatened by the repeal of the Patients Protection Affordable Cares Act, or essentially Obamacare, by the insurance mandate. But the Biden administration will likely reverse the main actions that were taken by the Trump administration to actually basically mitigate the Affordable Cares Act, or basically reduce its influence. Where we see future growth, we essentially expect industry revenue. It will likely remain highly correlated with total health expenditure, which we're basically expecting it to rise. And we expect it to continue to trend upward for over the next 5 years. The industry's average profit margin is measured by their EBIT, and it's forecasted to decline slightly to around like 8% of industry revenue in 2025. But despite constrained profitability, revenue is projected to increase at an annualized rate of 1.3% over the 5 years to 2025, reaching a 1.1 trillion valuation. That's mainly largely due to increased demand caused by the same legislation that we were talking about. U.S. employment is expected to grow at an annualized rate of 4.5% over the 5 years leading up to 2025, according to the U.S. Bureau of Labor Statistics. And this may actually pose as a threat to the industry, since the majority of industry premiums are derived from group health insurance plans, which are typically employee-sponsored benefit programs. However, the anticipated 1.8% annualized increase in disposable income will likely support industry growth as individuals, families, and self-employed business owners will be in a better position to afford healthcare coverage. Also, as the median age of the US population grows at an annualized rate of 0.4%, we expect that overall demand for medical coverage will continue to rise. Also, the health and medical insurance industry it's currently in its growth phase of the industry life cycle, and over the 10 years leading to 2025, IBISWorld analysts estimate that the industry's contribution to the overall economy, as measured by industry value added, sometimes it's listed as IVA, will increase at an annualized rate of 5%. By comparison, US GDP is expected to expand at an annualized rate of 1.9% during that same period, and IVA, it's growing faster than GDP, supports the industry's growth position. So essentially, we expect that the industry at one point will actually surpass the growth of GDP. Sorry for that. The main success factors that we contribute to this are essentially having an extensive distribution and collection network. This is mainly an extensive network that covers hospitals, physicians, dentists, and it's important mainly for maintaining customer satisfaction and managing medical benefit costs. The ability to pass on cost increase, and this is essentially translated to successful forecasting of costs. Customer contracts are generally established in advance of the policy period, and when determining the premium rates to be charged, the plan provider must effectively underwrite these risks related to future medical costs. So obviously, health insurance companies really need to be very picky in terms of all of the calculations that they need to have in order to make sure that what they're going to have to pay out in terms of claims will actually be able to be sustained from their financial position. Also, the ability to raise revenue from additional sources. Many of the larger industry participants generate income from administrative fees related to managed care services. Some companies also generate fees from revenue for medical data management and IT solutions. Also, effective cost controls is another success factor that we're going to speak to later. And moving on to industry ESG material factors, we've mainly identified these 5. So GHG emissions being one of them, product quality and safety, which is also one of our main themes of the sector, customer welfare, product design and life cycle, and business ethics. And as you can see to the right, we just have a little graphic from Cigna's actual CSR report, basically outlining kind of like the little initiatives that they're trying to take with this. Now I'll pass it on to Mara for the company overview.
So to dive deeper into the company itself, Cigna is traded on the New York Stock Exchange under the ticker CI. It was founded in 1972 and is currently headquartered in Bloomfield, Connecticut. It's a leading global health service company with about 74,000 employees, with business segments of health services, integrated medical, international markets, group disabilities, and other. And it was ranked 13th in the 2020 Fortune 500 largest US corporations by revenue this year. You can see the stock performance in the chart above, and it has a 52-week range of 118.50 to 224.94 and is currently trading at around 206. The CEO and chairman is David Cordani. He has his bachelor's degree from Texas A&M University with an MBA from University of Hartford. And even outside of Cigna, he was elected chair of the board for America's Health Insurance Plans in 2019. So he is definitely a professional in this industry. Specific ESG efforts that Cigna really highlights are their focus on whole body health to improve health and cut costs. So instead of approaching a heart problem as just a heart problem, they'll also look at stress levels, mental health, diet, and nutrition to really address those issues. Additionally, they achieved their company's 2020 environmental goals set and benchmarked against 2013, which we'll dive in a little bit deeper when we go to the ESG analysis. This is just a representation of their revenue distribution. So you can see that mainly their revenue is made up of the health services and integrated medical segments, and about 96.8% of their operations are in the United States. And health services companies that are in the United States are expected to see a larger growth than health services that operate mainly outside of the United States due to the Biden administration. So now to go into the risks, mitigation, and ESG influence. The first two risks we see are price competition and claims exceeding estimates. So price competition is within the industry against competitors, how they can drive their prices down while still remaining at a good margin. And then the claims exceeding estimates means that they have to forecast out every year how much their customers are actually going to require them to pay for medication and services. And there's a risk that they might not financially correctly estimate that. And that's mitigated by effective cost management and their labor force. So next we see changes in drug pricing. So while the previous two were mainly about competition and their customers, changes in drug pricing is about their suppliers. So they can't control what big pharma prices their drugs at, and that is a risk for the company. And they mitigate that through funding strategic ventures focused on accessible and accurate healthcare, as well as evaluating drugs for efficacy, value, and price to assist client selection. So they're making sure that the drugs are affordable for their clients as well as useful. Then we have risks associated with acquisitions. Currently, they're Express Scripts acquisition. So that mainly goes over the main risks we see with all acquisitions. So that is maintaining employees and key management, retaining clients and attracting new clients, as well as integrating IT, communications, financial procedures, and operations, and finding operational synergies. So this Express Scripts acquisition was a pretty big deal for the company. Express Scripts is a company that mails out prescription drugs. So we'll discuss that a little bit more when we talk about access to healthcare, but they are working on mitigating, just making sure that it properly is acquired by their company. And that's mainly taken care of by their strong labor force initiatives. They also have the risk of failure to maintain satisfactory relationships with service providers and manufacturers. So this means they have to make sure that dentists, doctors, and drugs are covered by their plan. And that is mitigated by revising their code of ethics and their principles of code of conduct. So how are they conducting those relationships with those third parties? Next, having a lot of client information, they have the risk of cybersecurity issues, of being hacked, or having their data stolen. And that's mitigated by a dedicated cyber and privacy council comprised of company executives. So they are taking care of those risks. And then lastly, what we would normally call the opioid epidemic. On their company website, they call it the opioid and mental health crisis, because they're not only looking at opioid issues, but also looking at mental health issues that cause opioid use. So they mitigate that through various ways, including partnering with pharmacies, healthcare providers, and nonprofits to combat opioid use. They aimed to reduce opioid use by 25% by 2020. And that would bring it down to pre-epidemic levels, to like the normal opioid use level. And when they went to do that over the past 3 years, they actually reduced opioid use among their customer base by 50%, so much more than they were anticipating. Having this success, they're now ambitious to set a new goal to reduce opioid overdoses among their customer base by 25% by 2020. And again, with their whole body health approach, they're not only looking at opioid use, but they're looking at mental health issues of their customers that are on opioids, providing chronic pain support for those who are suffering, and intervening with connective care coordination and collaboration with stakeholders that can help make a positive change. Some other ESG influences they have had are included in the Dow Jones Sustainability World and North America indices in 2019, with the leading score for the healthcare providers and services industry sector. In 2019, Cigna received its 4th Innovation in Advancing Health Equity Award from the National Business Group on Health. And they've seen nearly 40% reduction in absolute greenhouse gas emissions at Cigna corporate headquarters and data centers since 2013. And as I mentioned, they've seen a 50% reduction in opioid use among their customer base over the last 3 years. So now to dive deeper into the ESG integration. As we mentioned, the industry material factors before, we see them affecting Cigna as a whole as well. So we're focusing on GHG emissions, product quality and safety, customer welfare, and product design and life cycle, as well as business ethics. So Their third-party data shows their Bloomberg disclosure score of 50.83, a Sustainalytics rating of 89.51, and a AA for their MSCI rating. For MSCI, they're above the industry averages for 5 out of 7 of the MSCI categories. So they're above the industry average for corruption and instability, corporate governance, labor management, ensuring health and demographic risk, which means managing potential risks and changes associated with public health trends and demographic changes. So that covers the rises and decreases in obesity, COVID-19, and large immigration or emigration, and carbon emissions. And then they are on par for the industry rating for privacy and data security. Mapping to SDGs, they cover no poverty, zero hunger, good health and well-being, decent work and economic growth, and climate action. So the first three, no poverty, zero hunger, good health and well-being, is mainly taken care of through the Cigna Foundation, which the company launched Healthier for Kids for Our Future, dedicating $25 million over 5 years to help fight for the 3 goals affecting children worldwide. Decent work and economic growth we see as the 73,000 plus employees, as well as their contribution to the growing industry. And for climate action, we see that their carbon emissions are some of the best handled in the industry. They reduce waste and emissions within their business, but also their supply chain. And then lastly, Cigna's approach to whole body health sets the company apart as they manage social and demographic risks that affect health, specifically focusing on inequalities and access to healthcare. This not only helps the customer, but also helps Cigna from covering future customer costs by addressing health issues now rather than later. Additionally, the company works to not only improve client health, but global health through their many initiatives focused on environmental sustainability. So since we're switching to more of a thematic-based analysis, we wanted to include this slide to go deeper into the ESG and map them specifically to our sector-specific themes, as well as BSIG's entire portfolio themes. And then we thought it was really important for any company's success to address how they're handling COVID-19 and current social issues, mainly the current social issue now being the Black Lives Matter movement. So our sector focuses on fair product pricing and technology and innovation. We see fair product pricing through Cigna's patient assurance program, as well as their accountable care organization programs. So the patient assurance program focuses on predictability. So they want to make sure that their customers know what their costs are going to be going forward so that they can take care of those prices. For example, a huge issue we see in this industry and in the pharmaceutical industry as a whole is the price of insulin is really surging, making it difficult for a lot of people to access insulin. So Cigna ensures that the customers will not pay over $25 for 30 days of insulin. Also, the acquisition of Express Scripts helped aid this by making it affordable for the products just to be shipped right to the patient and them not having to cover the transportation costs as they go out. As well as technology and innovation applies to the acquisition of Express Scripts as they're innovating the way that we actually receive our drugs and treatments. For the overarching portfolio themes, community access, we see coverage of non-health care specific costs, the patient insurance program, which I just went over, as well as acquisition of Express Scripts. So the coverage of non-health specific costs includes transportation to doctor's appointments, as well as things that could cause health issues. For example, in hot states such as Arizona and Texas, Cigna will actually help cover air conditioning costs to ensure that health risks such as heart attacks, heat strokes aren't occurring in their customer base. As I mentioned before, the patient assurance program makes sure that prices are actually what patients are expecting to pay. And the acquisition of Express Scripts makes sure that customers can have access to the medications they need without even leaving their home. That also falls under sustainable innovation, so we don't want to repeat ourselves there again with that theme. Then for a greener economy and environmental sustainability, they have specific yearly environmental goals. So as I mentioned, they did reach all of their 2020 goals based on their 2013 benchmarks. These goals were that scope 1 and 2 emissions were reduced to a target of 20%, facility energy reduction target of 15%, and a facility's water reduction target of 10%. Now they're going ahead and making sure that they're making new targets to continue these positive trends in the ESG scope going forward, and likely releasing targets for 2025. Lastly, under diversity and inclusion, Cigna has always had a health equity council, and now they have the Health Equity Council just this year, in response to Black Lives Matter, created the Social Determinants of Health Governance Council, which focuses on, it's comprised of a group of stakeholders from across the enterprise working to make sure that the social determinants of health that influence health outcomes and contribute to health disparities among our customers and the community at large are mitigated, and we can study the data and figure out how to better help these customers. And then for COVID-19 and social issues, during COVID-19, they continued to provide interim health insurance for commercial services. So this was if people were losing their jobs, as the unemployment rates were surging, they were making sure to have interim health insurance covering for these customers. They also implemented a cost share waiver, so they would share costs with the customers if they couldn't cover their plans as full. And then they implemented new virtual care reimbursement policy. This is a huge trend we're seeing in the healthcare industry as healthcare becomes virtual. That was something that the healthcare services providers had to adjust to, because previously they may not have had coverage for virtual care, and now have established that. And as I mentioned before, they established the Social Determinants of Health Governance Council, and also launched Building Equity and Equality Program in response to Black Lives Matter movement. So the Building Equity and Equality Program is a 5-year initiative to expand and accelerate our efforts to support diversity, inclusion, equality, and equity for communities of color, with a mission to provide improving health, well-being, and peace of mind to those that Cigna serves by eliminating barriers to health and improving access to care, expanding Cigna's Health Equity Council, having all employees sign a commitment to inclusivity in professional and personal lives, and requiring unconscious bias training for all employees, as well as cultural competency for all managers. They partnered with Diversity Inc. for inclusive conversations surrounding racism to create educational opportunities, promote equity and equality and career advancement, and they have also committed to supporting minority businesses with a $1 billion commitment to have diverse suppliers by 2025. And then, as we mentioned the MSCI ratings before, we wanted to make sure that you had a good grasp of where everyone else in the industry stands. So they are highlighted in gray as the AA, and as you can see, the blue arrow means that they continue to improve their scores. And then as we saw this raised not a big flag, because obviously they're doing very well, but we wanted to make sure we were making the right decision instead of going with Henry Schein, which was ranked above them in this industry. And then when we looked further into Henry Schein, it's actually 10 times smaller than Cigna, so it's not a valid comp in the based on size of the company. So then we looked further into the Sustainalytics rankings and Bloomberg disclosure scores. We could go to the next slide for that. And so this, we took the actual comps that we used in our model, which were more comparable size to Cigna. And as you can see, they outrank the median in almost every area. But specifically in Sustainalytics, which all companies had data for, they were the highest performer in that ranking with 89.51 over the industry median of 65.98.
Now, just moving into the valuation, we're going to start off with our comps analysis. As you can see, Cigna is essentially trading on average on both the EV to sales and EV to EBITDA multiples, while also trading at a discount for EV to EBIT and also their PE ratio. This essentially shows that compared to its peers and metrics that we utilize, at least for our analysis, Cigna should be viewed as trading at a discount. And also given the low PEG ratio, so essentially that's just your PE ratio over the expected growth rate, analysts are actually estimating Cigna to actually outgrow its peers. These are our key assumptions that we use. We use a lower tax rate, also given the basically the low tax rates that at least we've seen in the Trump administration. And also this has been pretty much on average with what Cigna has paid. Our discount rate is at 7.74%. If you look at online sources, you'll see that analysts are actually using an even lower discount rate. But as you'll see further, we ran into a little bit of obstacles because of that. We're still using a conservative 2% perpetual growth rate, but as we said before, we think that the industry will actually outgrow GDP for at least some time, and everything else is essentially explained, at least in our model, if you get time to see that. On the right, you also see our WACC calculations, which again yielded us a 7.74% WACC. So just to go into a little bit of the modeling issues or obstacles that we essentially encountered, and then how we essentially mitigated that risk or went basically through from that. Cigna actually introduced a new accounting reporting format from 2016 onwards, which essentially caused issues with both FactSet and also Bloomberg standardized financial statements. So the statements and the numbers are actually standardized on these data providers, does not align with their 10K numbers. So that obviously posed a really big issue, at least for some time for us. The valuation of the company that was produced from our DCF because of these discrepancies would yield a value of $342, which would imply an upside of almost 66%, which we think it's a little bit too aggressive. So we decided to basically offer a different solution. And after reducing all assumptions to be as conservative as possible, we were unable to find an intrinsic value that really reflected the true value of the firm by our standards and also different analyst standards. And we also used online valuation calculators that we could find online, and an even larger intrinsic value would actually pop up in these calculations, implying an upside of almost 330%. So we decided to use relative valuation based off of the comps, and also use analyst ratings on FactSet to set our bear and bull scenarios, as you'll see later. So this is just a snapshot of our DCF. As you can see in the bottom left, you'll see that our intrinsic value actually turned out to be 342, like we said previously. But we ended up just going with a blended price target, where we essentially took part of the DCF value that we created. We also did a comps analysis, as I showed in a little bit, and we also took analyst recommendations. We assigned a different weight to each of these. Basically, we were just in conversations from obviously all the analysis that we've done, and we thought that applying 10% weight for our DCF, 60% for our comps, and also 30% for analyst recommendations would give us at least a closer price estimate to what we would realistically see. And that would essentially give us a price target of $261.96, which would imply a 27% upside in the coming year. So just to go into a little bit of a credit analysis and ratings, like we said before, they acquired Express Scripts in 2018. They actually issued around $25 billion in debt. So that obviously affected their cap structure and their ratings, as you can see from some of the data providers or some of the credit rating agencies actually have a negative outlook on them. Others have a stable stable outlook on them. And as you can see, their rating actually changed. You can't see it right here, but essentially their rating did change due to the issuance of this debt, because it changed pretty much all of their capital structure. I know this may pose as something almost like a red flag, but as you can see from this debt maturity schedule, you can see that most of their debt is actually due even beyond 2030. So essentially 2040 and 2050 is when most of their bond issuance will actually be due, or not their bond issuance, but at least their bonds will actually mature in 2040 or 2050. So we do believe that Cigna will be in a really good financial position to actually be able to pay off the debt that they have on their balance sheet right now. So just going into analyst ratings, as you can see here, 26 analysts covered the stock, with 23 of them recommended a buy, and basically 3 of them just saying that it's a hold, with none of them saying that we should sell the company. They're expecting a 12-month target price of $253, which is also what we listed in our blended price target. And as you can see, this is just a further detailed table of the analyst ratings, which is essentially where we came up with our bear and bull cases as well. So our price targets, we expect that in a bear scenario, we would expect a price target of $230, which would still imply an upside of almost 11%. Our base case would be $261.97, which would imply an upside of almost 27%. And our bull case would essentially be a price target of $280, which would be a 35% upside. And based on our analysis of the company and industry's future growth opportunities, considering and combining 3 different price targets, Cigna's risk management, strategic acquisitions, and positive ESG actions and ratings, we believe this to be the future value of Cigna Core. And our conclusion is that the 26.6% upside combined with an annual dividend creates strong financial value. Compared to the industry, Cigna trades favorably amongst competitors and outranks them by ESG standards. Cigna's approach to whole body health helps mitigate customer and financial risk while improving good health and well-being standards as a whole. And with the new U.S. administration and increased importance on global health due to the pandemic and the aging population, Cigna's positioned to attract and maintain a strong customer base to continue to grow revenues. So please join us Tuesdays from 7 to 8 if you want to come to our sector meetings, and obviously our contact information is there. Thank you for your attention, and if you have any questions, please feel free to ask them.
Not a question, but just a comment. So I actually interned with Cigna over the summer. And in terms of like the ESG stuff that you were saying, like I could definitely attest to the fact that they're not just like saying it or like doing it as a marketing tactic, but like the entire corporation would have these like town halls, and they had to do like 20 more than they were planning on it because so many employees wanted to go and like talk about diversity and inclusion and everything that was going on. And I know like not their CEO, and I don't know the exact name. I don't even know if you mentioned him, but he's like the CEO's right-hand man for the international section. Like he's a like Black man, and he had like amazing things to say, and is like really pushing a lot of these initiatives. So I could definitely say like from the summer that they truly like do kind of like walk, like, you know, talk the talk, walk the walk. Like they did a really good job with all that. And I think like the employees or whatever were like really receptive of it and like and stuff. So, and they sent out a lot of like really good company-wide emails and resources. And I know the training that I had to do as an intern, never mind like an employee, was like pretty comprehensive. So just as a comment, but good job, guys.
Thank you.
Well, if there's no questions, you guys did a great job, and you know, we're trying to let everyone leave a little early today. You know, like some people might be driving home or whatnot for Thanksgiving. So I hope everyone has a really great break. And again, don't forget to apply to the healthcare analyst role if you're interested for next semester.
All right, thank you guys.
Thanks.
Thank you. Happy Thanksgiving.